Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.15 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we're going to cover three basics: what algo strategy diversification actually means, why it matters for keeping your trading safe, and how it shields you from the danger of relying on just one robot. By the end of this short video, you will understand the core idea of spreading your automated trades across different approaches, just like you would spread your money across different savings accounts to avoid putting all your eggs in one basket. We'll use everyday analogies, plain language, and real-world Forex examples, so you can walk away with a clear mental picture and a simple rule you can apply right away. No jargon will be left unexplained, and we'll keep the math light, just the concepts you need to start thinking about diversification in your own algo portfolio. Let's get into it. All right, let's define algo strategy diversification in the simplest possible way. Imagine you have two different robots that trade for you. One robot, we'll call it the trend-following bot, likes to ride big moves in the market. It buys when the price is climbing and sells when it's falling, much like a surfer catching the biggest waves. The second robot, the mean reversion bot, prefers to hunt for price pullbacks. It sells when a pair gets too high and buys when it drops too low, similar to a shopper waiting for a sale before buying a favorite item. When we talk about diversification, we simply mean using both of these bots together instead of relying on just one. By combining two approaches that react differently to market conditions, you create a more balanced overall performance. If the market is trending strongly, the trend-following bot will likely profit, while the mean reversion bot may sit idle or even lose a little. Conversely, in a choppy or sideways market, the mean reversion bot can capture small swings while the trend follower might see flat results. The importance lies in the fact that the two robots are not moving in lockstep. Their results are less likely to be identical at the same time. This reduces the chance that a single bad market condition will wipe out all your automated earnings. Think of it as having two friends who each have a different hobby. If one friend can't come over because of rain, the other can still join you for a different activity. In trading, that flexibility translates into steadier, more reliable returns over time. Now let's see why diversification actually protects you from the danger of a single strategy failure. Picture a single robot that trades only one way. For example, a trend-following bot that loves big moves. If the market suddenly turns sideways for weeks, that bot may sit idle, and a few unexpected reversals could cause a steep loss, just like a farmer who plants only corn and then faces a drought. In a chart, you would see a sharp drop in equity, perhaps from $10,000 down to $6,000, representing a 40% loss. That is the risk of putting all your automated capital into one approach. Now imagine you add a second robot that behaves differently, such as a mean reversion bot. When a market is flat, the mean reversion bot can still capture tiny bounces, adding small gains while the trend follower is quiet. When a sudden reversal hits, the mean reversion bot may actually profit, offsetting the loss from the trend follower. When you plot the combined equity curve of both bots, the line moves more smoothly. It might dip a little, say from $10,000 to $9,200, but then climb back up to $11,500 as the two strategies balance each other out. The overall drawdown, the biggest drop from a peak, is much smaller, and the final profit is higher. This is the essence of risk reduction. By not relying on one single source of returns, you avoid the scenario where a single bad market condition wipes out your entire account. Think of it as wearing both a raincoat and an umbrella. If one fails, the other still keeps you dry. For a beginner, the practical takeaway is clear. Always pair at least two bots that react differently to price action, and you'll see a steadier, more resilient performance over time. All right, looters, let's bring the idea of diversification to life with a real-world example. Imagine you have two tiny robots or bots that trade the euro to US dollar pair for you. The first bot follows the trend, which means it looks for a steady upward movement and rides that wave. Think of it like a surfer waiting for a big swell. Once the wave builds, the surfer hops on and rides it all the way to the shore. In our chart, The euro to US dollar has been climbing from 1.0800 to 1.0950 over several days, a clear uptrend. Our trend following bot spots the early rise at 1.0820, jumps in long, that's buying, and stays in the trade until the price reaches 1.0950, where it exits with a profit. Now meet the second bot, the mean reversion robot. This one believes that prices tend to bounce back toward an average after moving too far in one direction. Picture a rubber band stretched. It wants to snap back. In the same uptrend, the price briefly dips to 1.0920, forming a small red candle. The mean reversion bot sees this pullback as an overextension, sells short. That's betting the price will fall at 1.0920 and then buys back at 1.0880 when the price rebounds toward the trend line. Both bots make money, but they do it in opposite ways on the same market. By combining them, you capture profit from the main uptrend while also harvesting the small wiggles that happen along the way. This simple pairing shows how diversification can smooth out the ups and downs of a single strategy, giving you a steadier overall result. Now that we've seen how two bots can complement each other, let's walk through a step-by-step process for selecting the right pair of strategies, even if you've never written a line of code before. Step 1. Decide what market behavior you want to capture. A trend-following strategy thrives when prices move in a clear direction, like a river flowing downstream. A mean reversion strategy shines when prices bounce around a tight range, similar to a ball rolling back and forth in a shallow bowl. By choosing one that chases a river and another that watches a bowl, you're already covering two very different scenes. Step 2. Check historical correlation. Correlation is a statistical measure that tells you how two things move together, ranging from -1, exact opposite, to +1, exact same. Grab a free charting tool. Pull up the performance curves of a potential trend bot on euro to US dollar and a mean reversion bot on Australian dollar to Canadian dollar and run a simple correlation calculation over the past 6 months. If the result is close to 0, say below 0.3, the two strategies are not moving in lockstep, which is what you want. Step 3. Make sure the risk limits fit together. If your trend bot risks 2% of your account per trade, and your mean reversion bot also wants to risk 2%, you might end up with a combined 4% exposure, which could be too aggressive for a beginner. Adjust the risk settings so the total never exceeds, for example, 3% of your capital. By following these 3 steps, identifying distinct market behaviors, confirming low correlation, and aligning risk limits, you'll build a diversified algorithmic portfolio that can weather both calm and stormy market days. The final piece of the diversification puzzle is setting different time frames for each algorithm, and this is easier than it sounds. A time frame is simply the length of time each candle on a chart represents. Think of it like looking at a photograph. A close-up shows every detail, while a wide-angle view captures the big picture. For our trend-following bot, we often want to see the big picture because trends develop over days or weeks. So we might give it a 4-hour or even daily chart, allowing it to catch a steady upward move without being distracted by tiny price jitters. Conversely, a mean reversion bot thrives on short-term price wiggles. It benefits from a faster, more detailed view, like a 15-minute or 1-hour chart, where it can spot a price that has strayed too far from its average and is likely to snap back. By assigning the trend bot a 4-hour time frame on euro to US dollar and the mean reversion bot a 1-hour time frame on the same pair, you let each robot work in its comfort zone. Why does this matter? Because the two time frames often generate signals at different moments, reducing the chance that both bots will be in the market at the same time and exposing you to the same risk. It also spreads your capital across both short-term and longer-term market moves, smoothing out the equity curve. To implement, simply open 2 separate chart windows in your trading platform. Set the appropriate time frame for each and link each bot to its designated chart. Remember to keep the overall capital allocation in mind, so the combined exposure stays within your risk budget. With distinct time frames, you give each algorithm the space it needs to perform, turning diversification from a buzzword into a practical advantage. All right, looters, let's talk about how you actually put your money to work when you run two different algorithms. Think of your trading capital like a pizza you want to share with two friends. You wouldn't give the whole pizza to one friend and leave the other starving, right? The same idea applies to algo trading. You want to allocate a portion of your cash to each bot based on how much risk each one carries and how much you expect it to earn. Let's say you have a total account balance of $10,000. You have decided to run a trend-following bot that rides big moves and a mean reversion bot that looks for price to bounce back after a dip. A common rule for beginners is to start with a 60-40 split. That means you would assign 60% or $6,000 to the trend-following bot and the remaining 40% or $4,000 to the mean reversion bot. Why 60-40? The trend bot usually trades on longer time frames and can handle a larger position, while the mean reversion bot often trades more frequently and may need a smaller cushion to survive short-term whipsaws. By allocating proportionally, you keep the overall risk balanced. If the trend bot has a losing streak, the mean reversion bot can still provide steady gains, and vice versa. It also makes it easier to compare performance later because each bot is working with a known slice of the pie. Remember, the exact percentages can change as you learn which strategy fits your style better. But the key takeaway is to never dump all your capital into a single bot. Spread it out, keep the slices reasonable, and you'll give yourself a built-in safety net that protects your account from one big loss. Now that you've split your capital, you need a way to watch how both bots are doing together. Imagine you have two friends playing separate video games, and you want to see both scores on one TV screen. That's exactly what a combined dashboard does for your algorithms. In a typical trading platform, you can create a single page that shows three things at once. First, the top chart displays the overall equity curve, a line that tracks the total value of your account as both bots trade. When the line moves up in green, you're making money. When it dips down in red, you're losing money. Below that, you have two smaller charts side by side. The left one shows the performance of the trend-following bot, maybe trading the euro to US dollar pair, with its own green and red bars that reflect each trade's result. The right chart does the same for the mean reversion bot, perhaps trading pound sterling to US dollar. By looking at this layout, you can instantly see if one bot is dragging the overall result down, or if both are contributing positively. Most platforms let you add alerts, so if the combined equity drops more than a set percentage, you get a pop-up or email. You can also set a simple rule. If the trend bot's equity falls below a certain level, you temporarily pause it while the mean reversion bot continues. The visual cue of the combined line helps you make quick decisions without opening dozens of separate windows. This single-screen view saves time, reduces confusion, and gives you a clear picture of how your diversified strategy is really performing in real time. Finally, let's talk about a common pitfall that many beginners fall into: loading up on too many bots that all do the same thing. Picture a group of friends all deciding to wear the same raincoat on a stormy day. If the raincoat tears, they're all soaked because they didn't bring any backup options. In trading, this translates to running several algorithms that follow the exact same logic, like three trend-following bots all trading the same currency pairs on the same time frames. Because they are so similar, they react to market moves in the same way. When a market takes a sudden turn against the trend, all three bots will likely lose money at the same time. This is called high correlation. The bots' results move together like synchronized swimmers. The result is that your portfolio's risk doesn't actually go down, even though you have more bots. You might think you're diversified because you have three separate pieces of software, but in reality, you've just multiplied the same exposure. To see why this matters, imagine you have a $10,000 account and you allocate $3,000 to each of three identical trend bots. If the market drops 5%, each bot might lose about $150, totaling $450, a larger hit than if you had only one bot with the same $3,000 exposure. The better approach is to pick bots that behave differently. For example, a trend bot on euro to US dollar and a mean reversion bot on pound sterling to US dollar. Their trades won't move together, so when one is losing, the other may be winning, smoothing out the overall performance. Before you add a new bot, ask yourself, does this robot trade the same pairs, use the same signals, and operate on the same time frame as my existing bots? If the answer is yes, you're not really diversifying. Test the correlation between their equity curves first. If they move in lockstep, you're better off keeping fewer, more varied bots. This simple check protects you from the illusion of diversification and keeps your risk management solid. Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on lesson 11.15 of Unit 11, Algorithmic Trading Fundamentals. In this scene, we will explore how correlated strategies undermine diversification benefits. By the end of this segment, you will understand why using two bots that act alike can actually increase risk instead of reducing it. Let's dive in. First, let's define correlation in plain English. Correlation measures how much two things move together. A correlation of +1 means they move exactly the same way, 0 means no relationship, and -1 means they move in opposite directions. In trading, we often look at the daily returns of two algorithms and calculate a correlation coefficient. Imagine you have two trading bots. Bot A follows a trend-following approach on the euro to US dollar pair, buying when the price climbs and selling when it falls. Bot B does the same thing, but on pound sterling to US dollar. Because both pairs often react to the same global risk sentiment, the two bots will likely make money or lose money at the same time. On the chart, you see two equity curves, one green, one red, running almost side by side. The white box shows a correlation of 0.92, which is very high. Now, why does this matter? Diversification works like not putting all your eggs in one basket. If one basket breaks, you still have eggs in the others. But if all baskets are made of the same fragile material, they all break together. In our example, the two bots are essentially the same basket. When a market shock hits, both strategies could lose money simultaneously, wiping out the cushion you expected from diversification. The practical takeaway: before you pair any two algorithms, check how closely their returns move together. If the correlation is high, say above 0.7, you're not really diversifying. You're just adding more of the same exposure. Aim for low or even negative correlation to truly spread risk across different market behaviors. This simple check can save you from a false sense of security and protect your capital when the market turns against you. Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on lesson 11.15 of Unit 11, Algorithmic Trading Fundamentals. In this scene, we will walk through a practical tip, testing strategy correlation before deployment. By the end of this segment, you will be able to run a simple test to see whether two bots really diversify or just mirror each other. Step 1 is to gather the daily return data for each algorithm. A return is simply the percentage change in the bot's account equity from one day to the next. Most trading platforms let you export this data as a CSV file. For our example, imagine we have a mean reversion bot that trades US dollar to Japanese yen and a trend-following bot that trades Australian dollar to Canadian dollar. We download 90 days of returns for each. Step 2 is to calculate the correlation coefficient, often called Pearson's R. You can do this in a spreadsheet program like Excel or Google Sheets. Paste the two columns side by side, select the Correl function, and you'll get a number between -1 and 1. A result of 0.35, as shown in the scatter plot on the right side of the image, indicates a modest positive relationship, meaning the bots sometimes move together but also have independent moves. Step 3 is to evaluate the number. As a beginner, a good rule of thumb is to aim for a correlation below 0.3 for true diversification. If you see 0.8 or higher, the bots are too similar. In that case, you might replace one with a different style, such as swapping the trend-following bot for a breakout bot that reacts to price spikes. The takeaway here is simple. Before you allocate capital to multiple algorithms, run this 3-step test. Export returns, calculate correlation, and decide based on a clear threshold. This quick check helps you avoid the pitfall of stacking similar bots and ensures each algorithm adds a unique piece to your overall trading puzzle. Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on lesson 11.15 of Unit 11, Algorithmic Trading Fundamentals. In this final scene, we will connect diversification to the overall risk management framework. By the end of this segment, you will see how diversification fits into a bigger safety net that protects your trading capital. Risk management is the set of rules you use to keep losses small enough that you can stay in the game. Think of it like a seatbelt, airbags, and a sturdy frame in a car. Diversification is one of those safety features. It spreads the impact of a crash across multiple points instead of concentrating it in one spot. To make this work, you need a clear plan that tells you how much money each algorithm can use, how much loss you are willing to tolerate each day, and how you will monitor everything. Look at the dashboard in the image. The pie chart on the top left shows capital allocation. 60% of our account goes to a trend-following bot that trades euro to US dollar, and 40% goes to a mean reversion bot that trades US dollar to Swiss franc. By splitting the money, we ensure that a sudden drop in the euro does not wipe out the whole account, because the dollar franc bot may be doing the opposite. The combined equity line in the top right tracks the total account value, adding the daily profit or loss from both bots. Notice the green and red markers, green for profit days, red for loss days. The risk meter at the bottom left warns us if the daily drawdown, the amount we lose from a peak, exceeds 2% of the total capital. This is our hard stop-loss rule. If the combined loss hits that line, we pause trading for the day. Finally, the table at the bottom right lists each strategy's allocated capital, its typical daily volatility, how much its equity swings, and the individual stop-loss level we set for each bot. For example, the trend bot might have a stop-loss of 1.5% of its allocated capital, while the mean reversion bot uses 1%, because it trades more frequently. The practical rule: always embed diversification inside a full risk management plan. Decide on allocation percentages, set daily drawdown limits, and define stop-loss levels for each algorithm. Then monitor everything on a single dashboard so you can see the big picture at a glance. This integrated approach keeps you protected, helps you stay disciplined, and gives you confidence to let multiple bots work together towards steady, long-term growth. All right, looters, we've reached the end of our deep dive into algo strategy diversification. In this lesson, we learned what diversification means for algorithmic trading, why it shields you from the risk of any single bot failing, and how to build a simple two-bot portfolio that mixes a trend-following robot with a mean reversion robot. We walked through the steps of picking complementary strategies, assigning each a different time frame, like using a 4-hour trend bot and a 15-minute mean reversion bot. Then splitting our capital, for example, 60% to the trend bot and 40% to the mean reversion bot. We also saw how a single dashboard can show both bots' equity curves side by side, making it easy to watch the combined performance. Finally, we warned against the common rookie mistake of loading too many similar bots, explained how correlated strategies can cancel out the benefits of diversification, and gave a practical tip to test correlation before you go live. Remember, diversification is just one piece of a larger risk management puzzle. It works best when you also set stop-loss limits, keep an eye on overall drawdown, and review your results regularly. If you found this walkthrough useful, give this video a thumbs up, hit the subscribe button, and ring the notification bell so you never miss another lesson. Drop a comment below sharing which part of diversification you'll try first, or any questions you still have. That is everything for lesson 11.15, Algo Strategy Diversification. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.